Good morning, everyone. It is Monday, the 26th of September, 2016. It's 8:04 a.m. Chicago time. Starting a little bit late today, 4 minutes. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Of course, I'll let you read the news on your own as far as what's going on in the markets. You can always shoot me a tweet if you have questions. I won't spend time on that. We'll continue on that path. There are too many calendars and so on that provide good information. If you're looking for a calendar, one of the ones that I would suggest is to go to investing.com/economic-calendar. Check that out. It has holidays, it has filters, all kinds of stuff if you're looking for what's going on for the week. I'm still going to go over the key items going on this week to just line out the week for Monday. And to start with, today we've got Draghi, ECB's Draghi speaking at 9 Central, 10 Eastern, followed by ECB Speaker Nawatny at 11 Central, 12 Eastern, and then Fed Speaker Kaplan at 12:30 Central, 1:30 Eastern. For tomorrow, the key figure is consumer confidence, and not much in the way of speakers. However, Wednesday gives us durable goods, crude oil, but a parade of speakers, ECB speakers as well as Fed speakers. I'm counting 3 Fed speakers and 2 ECB speakers on Wednesday. We get unemployment change in Germany. On Thursday, we get core PCE and GDP in the U.S. Also on Thursday, impending home sales. And then on Thursday, also, we get about 7 Fed speakers and 1 ECB speaker. So it's a parade this week coming out of the Fed. And then Friday, we have several numbers coming out of the UK in case you trade the FTSE and so on. The U.S. has personal income and PCE core. And then we get Chicago PMI at 8:45 Central, 9:45 Eastern on Friday, followed by University of Michigan confidence at 9 Central, 10 Eastern. So a lot of input this week, but the key input right now, the key market risk that we're seeing, that I'm seeing right now, is with the debates tonight between the Democratic presidential nominee Hillary Clinton and the Republican nominee Donald Trump. There's a fair amount of uncertainty there, expecting some volatility either way. I'll be in front of the markets with the debates running in the background to see if there are any reactions. But both candidates have a polarizing presence in the United States, and the economy will be discussed, and that is expected to have some sort of influence on the way the market trades. Not that these people are in a position of power yet, but it may be a preview of what's to come. So that's how things are shaping up. Let's take a quick look here at what was expected for Friday. This is Friday's Trader Bite. The expectation on Friday is for the market to open up and push into the prior day's range. So we expected an open auction right here, and then we expected a push into the prior day's range, and then a responsive push, and then we expected sellers to step in and push this down into the 2159 area. That was the primary hypothesis. We were looking for the market to trade into that gap zone and to clear the gap zone down into the gap day high, which was, or the day before the gap's high, which was Wednesday. So that's what was expected on Hypo 1. Hypo 2, the opposite pattern. Open auction, a drop, and then buyers stepping in to take it through into the 2170 quarter point of control of the prior day, and then a test higher and above the prior day's high at 72.75, and then for it to settle sideways inside of Thursday's range. Here's what happened. We got an open auction, we got a test up, and then we rotated through all the way down into the prior day's range. So Hypo One was the winner on Friday. Tough trading through here, just sitting and waiting for the market to play its hand out. Just pushing through pretty much all levels, pushing through the prior day's low, mid, VWAP, playing into the opening swing, and then finally releasing to the downside before an opportunity came in at the mid here for a small rotation, and then the market attempted higher as it struggled to push through this 58 quarter, this essentially triple bottom here. It pushed higher and then it finally rotated down after testing the 2163. Not so much fun trading this. We have a double distribution profile with somewhat of a weak high on Friday and with a low volume node at 2161.75, which should be noted for the sessions going forward. Since then, the overnight session had us selling. So the market reopened at 56 and a quarter from a 58.75 close on Friday, tested higher, chopped around the point of control from Friday as you would expect, and then we started to get the rotations down. We have an initial impulsive rotation down, a very, very small pullback, continuation, and then it tries to correct into the mid here, and then once Europe opened, it's all selling from there, and the market has been sitting at the point of control at the high volume node below pretty much for the rest of the afternoon or the evening. Well, it's the afternoon in Europe or the morning for us. And so we're resting below the below the mid, below the VWAP, and it looks to me like it has not completed its leg down. The expectation is for it to chop and then continue to go for this 2144 and a quarter on a continuation. That's how things are shaping up in the overnight. Watching this mid slash LVN zone here between 51 and 52. That's the area I'm looking to measure the action from this morning. If it holds below, if it tests 51, 52 this morning and holds below it again, which I'm expecting it to, then look for a rotation through the point of control. So I'll pull back up here if it has that, because we do have a gap now. The expectation is for responsive buying back up. And then I'm looking for sellers to step in, take it through the point of control, push through, pull back to the point of control, and then retest this 2144 and a quarter and start attacking last Wednesday's range. So let's take a look at that. So last Wednesday, one of the plays that I was looking for on Thursday and also Friday, actually, I talked about this 2146 and a quarter area. It's the post-Fed LVN zone that we left behind here. Very thin, thin trading. And what I had talked about is once it breaks through and pushes through this closing price, which it hit to the tick on Friday at 56. Once it pushes through, we are likely to push through to 46 and a quarter. The overnight low is 44 and a quarter, 8 ticks through that. And so what it's done is it's discounted this low volume node, which is what we would expect on re-entry. And now we're back almost, we're starting to make our way back to the scene of the crime here at the FOMC. The FOMC trigger was at 2136. That is the scene of the crime, and the market is basically resuming that auction. So what we've had is a gap up, a test lower, impulse down on a higher time frame, push back to mid or so, a little higher than mid at 2163 on Friday, and this is your continuation move as the market retests this range here. 44 and a half ahead of the 44 quarter high on Fed day high, and then the beginning of the LVN zone at about 46, 45, 46. This is where we are now. We're resting. We're tapping on that door there. We're knocking on the door here. The key target below. Uh, once the overnight low breaks is 41 and a half, followed by the 36, and then we will have taken back what the FOMC effect that we got last week. Okay, that's what the context is right now. Trade imbalance. So you can see just complete balance here for days. Last week, trade imbalance, break up higher out of the FOMC, and then we have a gap overnight, and then the market stabilizes. Where does it stabilize? It stabilizes against the MC point of control of where we were before. This is the most valuable price, or the most traded price from where we were before. So let's show that here, where that black line comes from. There it is. This is the most traded price from before. We test the most traded price from before, and then the market starts shifting down, and what it's likely to do is to move down into the prior day's balance, push through the 4150 balance, and then the ultimate target would be 2132.50, and that brings us back into essentially the lower balance. I do not expect it. Now, this is the natural way that this is likely to play out. However, the expectation longer term for the week is that we push down, break this overnight low, go to 4150, and then find a bounce from here to come back and re-push back into the upper balance, unless, of course, news comes out that is not favorable. There's a lot that can happen this week here with the FOMC, with the Fed speakers, with the debates tonight, and so on. A quick look at the other thing is crude. Crude this week, we have the meeting in Algiers starting this week by OPEC, and the expectation is that since OPEC is not able to exercise any discipline, the group is not able to exercise any discipline in constraining supply. The expectation overall by the market, what the market is pricing in, is that it's not likely to improve the price of crude. And we got a $2.10 or $2.13 rotation yesterday from 46.35 up here all the way down to 44.22 on Friday. A really big rotation down, and the market has recovered somewhat and is trading right up against the 45.45 to 45.50 area. So what this is shaping up to be is the market's really not. It's bouncing back up because there have been some favorable comments about Algiers. But overall the market is nervous because, again, the group has absolutely failed on a political basis, for political reasons, has failed to actually curb supply. However, if there is any improvement on that, if there is a possibility that supply can be curbed, we could easily see crude push back up through the 47, 48 area, which puts us in the next key balance area above. As far as what we accomplished last week, here's the weekly profile. As I talked about last week, the market moved out of the upper balance, right? It had an impulsive move down, so it left a gap and a very thin day, a trend day. The next day, Monday, it pushed back up, took a lot of that back, and then over the next few days, it built balance down here. So we have a lot of balance up here. We have balance down here with a thin in between. We are in the thin in between right now. We're battling two areas. And what happened last week is it moved from that lower balance, put in more of a thin area in between, and then started to build balance up here towards the upper range. And it looked to me like last week, if it held Thursday, if Friday held Thursday's balance, then it's likely to push through and give us a new all-time high. Instead, Friday moved lower per hypo one there. It moved lower and retested this range down here, and then today we're trading even lower now at 21.48 and a quarter, right down in here. And it's knocking the door towards the lower balance that we were in last week. So that's how the weekly looks right now. So you can follow the auction on a higher time frame. On the monthly, this week is the end of the month. And so we're about to close this profile out for the month here. Let's pull it in a little bit closer. And again, you see the same thing, a lot of balance below on the September profile. We've pushed through. Here's where we closed on Friday, that asterisk right there. We attempted higher and are in between. So the market's really stuck in this 2144 to 2166 area right now, and I expect that with the parade of speakers this week, it's likely to bounce around in here, and that's essentially what we're setting up for this week, is a pretty wide rotation, bounces back and forth in this area for this week. That's what the big picture shows. As far as today, as far as what we have for today, I'm running out of time. We have a market that is gapping down. The gap size is about 8 points. The probability of gap fill, of the market filling the closing the gap up here on from Friday is very, very low. It's around 18% as it stands right now, based on 2,500 days. The expectation, however, is an open auction. We're opening inside of Wednesday's thin range. Now remember, because this is a thin range, there will likely be interest on both sides, even though it's Monday, and Mondays are usually dull on the open. There's likely to be interest on both sides. This can be seen as cheap for those who are stalking the buy side, and this can be seen as an opportunity to push and get those targets down below 41.50 and 36 by those looking to the sell side. So I'm looking for an open auction. I'm looking for responsive buying, which will likely fail. And then I'm looking for it to break the overnight low. And remember, I said watch the 21.51, 21.52 from the overnight session for resistance. And then look for the break of 44.5 and a target of 41.50, and that basically gives you hypo 1 with about 10 points of range today. Okay, the secondary hypothesis is another, again, an open auction, and then looking for a test lower, potentially to take out the overnight low, and then look for a bounce back up, and then and then look for it to bring us back into the 21.54 and the low of 21.56 from Friday. That's your secondary hypothesis. I'm losing my voice, I guess. Anyway, that's how things are set up for this week. Just remember, there's a lot coming out this week. The debates, the Fed speakers. We have Draghi this morning. All of that combines to give us some opportunities for the market repricing itself. And that's what we do as day traders, is we're taking advantage of repricing opportunities, inefficiencies in pricing, and we're looking to hop on those. And you can't hop on those if you are taking poor quality trades or impulsive trades or trades that are based on it feels like it wants to go down, it feels like it wants to go up. Trade what you see, not what you feel or want to see. That's what I'd like to push on you. You're probably closer to getting this than you think. Just hang in there, manage your risk, and good luck. I'll catch you tomorrow.